This is the Numbers Man Show from WBRN Radio and on the Bostonred Network. One of our programs in the group of programs we have, Bostonred, our political program, the Open Source Report, our technical program, All About Sports, the sports-oriented program, BR on the World, our international program. Thus, we have a number of these, and they all tend to be integrated, or they will be more integrated in the future. Thus, we look forward to 2020. This week in economics on the 17th of November 2019. We'll look at the stock market and what it is, at the goalpost, so to speak, the standard 2800, and make some comments on it, because the market has entered more and more into macroeconomics. It's one of the factors that the Fed and other central banks look at, various markets in various places, commodity prices, etc. We at Cranston Analytics have been looking at these for a number of years, over a decade. Thus, as they say, the catalog expands. The Fed is now using the ADP group as one of their data sources for big data, because they have the employment numbers based on payroll. It's a payroll company in the U.S. And there are various other things happening here. Last episode we talked a little bit about climate change as an economic factor, and it's beginning to enter into global economy much, much more, as is global economy itself. We had a number of PCIs from the market people, and on a number of nations. There are a lot of statistical stuff, all basically pointing more or less the same picture was painted of these various nations, whether it be in the EU or other nations, China, and a moderation of activity, whether it be sales or be manufacturing. In the U.S., manufacturing is officially in a recession. Here, we'll have on this broadcast retail sales out there, one element of the economy that is, I believe, that we'll get to it at 3% there. You're not going to see today that retail sales grow at 2% or 1.5%, basically. Now, there could be some exceptions, that you have some surges in the numbers, but the psychology of the market is sort of settling in. This is why we'll start with the stock market, and a good place to start is Aramco, the Saudi national petroleum company. They have a flotation valued at $1.7 trillion there, and they are going to have a IPO. The firm says at 1.5% of its shares will be put up for sale, and that'll be the largest public offering so far in the history, or at least one of the largest. They say the largest out there. People will be able to bid, to participate in it, and the idea is to raise money for the Saudi sovereign fund. And many nations have these sovereign funds out there. Norway has one, Sweden has one, etc. And those funds are set up for rainy days, quote unquote. That's an American term, but nonetheless, it is out there, and people are looking at it more and more as a hedge, as one would say. The Saudis have long-term plans, no doubt about that. They've been in the petroleum business when the British put them in the kingdom of Saud, and they have accumulated certain expertise. Now, the use of engineers from all over the world, basically at one time Exxon and various other companies were what is now Saudi Aramco, and now the state owns the company. So they're exploring ways, including solar. They have large solar farms. They have large wind farms. And they can also use their sovereign fund to invest in other ventures to modernize their kingdom, because they have not been immune from the various economic problems of, quote-unquote, the global economy. So they are opening, as they say, a new page there. And I'm looking at the BBC here. That was where I started off, because this particular program will not be as long, which the listeners will appreciate. Australia is asking for Brexit trade compensation. Brexit will be a game changer, no doubt about that. The election in the UK in early December, and the Tory party has promised they will make an exit from the EU. Now, there have been the latest extension. There have been a lot of extensions there until the end of January. But that is a much closer date than one would expect it to happen. So that is a global item for the UK, its trading partners. It will affect the rest of global trading. Make no doubt about that. Now back to the 2800. There are trade talks, not only between China and the U.S., but the EU, the UK, the U.S., and Canada, and various other people. This idea of tariffs, they've been around for a very long time. We remember the smoot tariffs that historians have pointed to, that were one of the causes of the Great Depression. The whole problem here is in modern capitalist systems from the very beginning, back to Adam Smith. Adam Smith thought about the whole idea of trade, less monopolies, what he called invisible hand, the Scotchman there, and then to more modern times as the world industrialized. That was primarily in the UK. You had factories and industrialization. Reading an interesting book here called Rage in the Machine. Very interesting in the sense of how by Robert Smith, is how industrialization patterned the way that the education system is set up in industrialized nations, and basically the way that things, quote unquote, are done. It's sort of like a factory line, etc. Now, what is happening at this stage of the game, the way that factories are operated, etc. Henry Ford started out the automated line, and of course he was able to make billions of dollars doing it. But that particular business model has been modified, and that is where we have more, and we see more and more equity. This is the markets, whether it be in stocks, bonds, or in futures, commodities. They all play into this market, and those types of activities are increasingly automated. That's the whole idea behind the Rage in the Machine, talking about artificial intelligence and basic types of algorithms that are running these programs. All the programs that the would be at the stock market, the London Exchange, etc., are run on those types of programs. So thus what we get is programming types of trading there, and the psychology of the market. That's back to the 2800. And one hypothesis is if they solve the trading part of the puzzle, particularly with the U.S. and China, the market could increase to 2900. Now, our commentary here is around those benchmarks, whether it be 2,800, 2,900, or 3,000. That is the psychology of the market. It just tells one where the market is trading at any given time. What it does not necessarily tell a person is how individual components in the market are performing. You have the S&P 500. You can look at those and various other things, and we'll get to that in the Russell 2000. Various ways of looking at the market, but the market is out there. But we still have the industrialized nations' economies. Now that's where the central banks come in, and we have monetary policy and more economic types, economists, analysts, pundits, whomever, are talking about the role of the central banks. Now, of course, interest rates are lower than ever. In fact, some nations have what's called negative interest rates, and that's part of the toolkit. But again, if you empty out the toolkit, that is one reason at this mic we oppose the rate cuts in the interest rate. Because if the lower you cut the rate of interest, you do not have that tool if a downturn appears. Now, there's certain other things, quantitative easing. There's a light quantitative easing going on. But what that basically tells one is the economy is not as robust as some of the pundits, propagandists would have people know. And if you look at the real employment rate, I think it's about 7, as opposed to 3.5, 3 point wherever it is now. We have always maintained that number in itself is not as important as the number of people working. Now that seems to be contradictory, but when you get to the actual numbers, and that's what we have in big data, we can look at it as being, say, a 7.5, or it could be almost 8. But that is what Karl Marx called the reserve army of the unemployed. And it's been somewhat modified, not only the unemployed, but the underemployed, what we call them the underutilized. Well, those things are out there, and we know they're out there, and that is how the economy is operating. Raises have been at one point around 3%, but lower than in other so-called boom times. And the reason for that is there's a reserve army of people that could be put into the work chain, or there's also situations where the skilled workers that they need are just simply not available. Construction industry suffered from that because in the Depression, massive amounts of construction workers were laid off. And when people are laid off from a particular job, trade, etc., for a number of months, a number of years, they find other types of work. They disappear, and many times they do not return. And that's what's happened with construction, also faced with raw material demands also, depending on how they're building these houses. Not as much plywood available as there once was, and also the cost of materials. In the PCIs, we talk about that. Material costs, very, very important there. And the land issue, finite, it's not finite. In some communities, there's just simply not any available land, so they're having to tear down old housing stocks, old buildings, to make room for newer buildings. And many cities are going now for density. That is their cry, because obviously if you build up, you have more people and more commercial retail outlets available to you. And so thus that's happened here. Look at a story here in the BBC, and the second in San Francisco, what's happened there to the housing market. It's not sustainable. That'll be our next story here. We thought we would come with some stories first. There are always stories. And this is about the U.S. Tech industry entering into the more philanthropic part of, this is by Natalie Sherman on 17th. Anyway, while they're putting billions of dollars into housing because they need to sustain their business models. Now this is San Francisco. They call it the center of America's thriving tech industry, which they had roving blackouts where they were literally in the dark because of climate change. With some of the highest housing costs in the U.S., homeownership is in retreat. Homelessness is surging alongside newly minted fortunes. So this is part of it, and they have a history teacher named Leon Satan. Anyway, Satan currently lives in a rent-subsidized one-bedroom apartment with his wife, who also works in education, and he has a 4-year-old son. When they moved to a bigger place a few years ago, their rent almost doubled. Now, in San Francisco, said when he was born in 1978, a two-family income could buy a house. At this point, the only way to buy a house, if you're a normal person, is to have some sort of edge. And he says he feels lucky, I guess, to get the subsidized house. Santan and others blame the changes in the Bay Area tech boom, which has created vast wealth divides. Fights over taxing of techs. That was the same situation. They wanted to have a tech count up in Seattle, and the voters passed it, and then it was finally overruled. Anyway, there are fights over new taxes, protests against the commuter buses that ferry workers south from San Francisco to Silicon Valley, where many of the tech giants have their headquarters. They were actually throwing rocks there. And I was at a tech conference and talking to some woman and talking about buses and people throwing rocks out of anger at them, and with a gleam in my eye. And then she said, well, I was on one of those buses, and I didn't say any more. Anyway, as Google is investing $1 billion, Facebook has pledged also $1 billion. That doesn't mean they have anteed up the money yet, and Apple $2.5 billion to the issue. We know the course we're on is not sustainable. That's the Apple boss, Tim Cook. He'll be incidentally, I believe, this week in, where will he be? I think in Texas with President Trump, looking at one of their manufacturing facilities. The move follows a flurry of small donations and activities from Microsoft and Cisco, which what are they investing? $500 million. And that is in Washington State, which we alluded to earlier here. Soaring prices has boomed. House prices and asking rents in the Bay Area have roughly doubled over 10 years, becoming by many counts the highest in the U.S. That's happened in a number of cities in New York and wherever else. Last month, the San Francisco Association of Realtors said the median house price in San Francisco was $1.4 billion. And asking for rents, it exceeded $3,200 per month. That's according to research from Moody's Analytics. Evidently they bought wages in the area have increased as well, but not as fast as housing costs. A family needs to earn $126,800 a year to rent a typical 2-bedroom apartment. You imagine that, over 6 figures. San Francisco, without spending more than 30% of their income. Typically considered affordable. 2017, about 40% of Bay Area renters spent more. For Mr. Sultan, house ownership is out of the question. He is lucky there's a woman on his street living in her car. No doubt. There are a lot of folk in this city who are struggling very hard, way harder than he is. The high costs are forcing companies to pay more and work harder to find a staff, and one reason tech firms are pitching in, obviously, self-interest. Apple is lending the state up to $1 billion to help finance affordable housing projects, providing $1 billion to California First Buyers Fund. And this is, what they have done. Google is in the act also. But this is just a drop in the bucket. This is Google and Facebook, said their plans should produce about 20,000 new units, some of which are being offered below market price. That's the trick right there. If they're market price, it doesn't matter how many. They could build 1 million units in their market priced, and people could not afford them. But he expects Apple has not provided estimates of its total commitment, but expects to build 3,600 new affordable units on its land. It's kind of like the company store. And go on here between 2012 and 2017, San Francisco has added fewer than 21,000 new housing units, while the population has grown by 58,000. The number of jobs jumped by 130,000. That would seem to be a very thriving economy. You get over 50,000 new people, your jobs up by 130,000, but it just doesn't work out. From Pete Coyne, he's with the Council of Community Housing Organizations, said it's simplistic to rely on increased supply to solve the crisis. New construction is often designed for the tech companies' upper crust. Many of the new jobs are lower wage. Now this is where this reserve army situation comes in, such as cooks and drivers. They are part of the supporting cast. They can't afford to live there. They're living in their cars or paper boxes. He said the tech industry announcement seems in part like a branding effort to preempt new policies such as higher taxes. There's no doubt about that. The big issue for me is why tech companies have to be housed in San Francisco. Why can't they dispense throughout the nation? Well, Apple, and I believe this is where President Trump and Cook has created a $1 billion Texas base, the community that rejected Amazon. So you see these tech companies are basically moving from community to community. They're very mobile in their various enterprises. The only question there is how much growth that Apple can get out of their iPhones and other products. Now, Apple, like any other global corporation, can't just rely on North America. They need to be in other places. So if they're producing iPhones or wearables, they're now in the music business. They're in several other enterprises, along with various other corporations. So this is where it's a very, very interesting situation as to where these various firms are going. They can go to Texas, they can go to North Carolina. Amazon went to Washington, D.C. When they were rejected in Brooklyn. So again, that's what we have. Let's look at this retail study here. We'll eventually look. Anyway, this is the advanced monthly sales for retail and food services released by U.S. Bureau of Census. Announced a advanced estimate of U.S. retail and food service sales for October. Let me just get this up a little bit here so we don't need to strain our advanced monthly sales here were $526.5 billion. That's for October 2019, and that is 0.3%. Now revised for September, it was $525.2 billion, a negative 0.3% September. So the next release will be on December 13th. The advanced estimate for October, adjust for seasonal variations, holidays, trading days, differences, but not for price changes, and we've already given that. There was an increase of 0.3%, or we could have 0.4 from the previous month, and 3.1% are plus 0.7 above October of 2018. Total sales for August of 2019 through October were up 3.8%, 0.5% from the same a year ago. The August 2019 to September 2019 percentage change was on revised from down 0.3%, 0.2%. Retail trade sales were at 0.3% from September 2019 and 2.9% above last year. Non-store retail sales were 14.3% from October of 2018, and gasoline stations were down 5%. The 2019 Advanced Retail Sales Report, deep dive in here. Okay, now these are the retail sales 10-month totals, and it is in millions of dollars anyway. Total $5,101.98. That's the 10-month total 2019. And we break this down a little bit here. Some of the components within it. Motor vehicles and parts, where they were here. Change for them. Let's see, this is a 10-month period. 3.7%. In October 2019, they were 1,004. That should be 104 million. I'm sorry, 508,000. September it was basically 100 million, and in August it was 6 million there. And last year, 2018, it was 99 million, and it was 96 million in September of last year. So sort of looking at some of that was the 10-month total, and if we go to September, it's 105 million, not 17. Was in August it was 106 million, and in October of 2018 it was 101 million. So a little bit stronger there. New car dealerships, well, they don't have that information in yet. Well, they do. I'm sorry about that. It was 77 million there, and pots and what have you, 7,823. Furniture, home furniture and stores there. If we look at 2019, 95 million, 238. If we look just to October of this year, 9,844. So basically, they've been in the 9 million in October. They already went 9 million in October of 2018 also. So we quickly move to electronics. 75 million there. That's the 10-month average. And for October, it was 9,844. Excuse me, I'm sorry. It was 75 million. It's electronics, and for October it was 7,621. And if we go to October of 2018, it was 7,864. So it was better last year in that particular business. And food and beverage stores here, 10-month for running, 641 million there. And if we go to October, 65 million. Food and beverage stores, 65 million there. And if we go to October of 2018, it was 63 million. A little bit of growth there. And health and personal care stores, on a 10-year run, they were at 293 million. For October, they were 30,594,000. Gasoline stations, of course, were down. They were down 0.5 tenths, and in October it was 44,379. Go to October of 2018, it was 46,607. So again, prices going down And we go to clothing stores, 208 million. That's over a 10-year period. They were down again and have been down 5/10 there. 21,113 there, and last year they were 21,437. And then they have, of course, men clothing, women clothing, men clothing 754, women clothing slightly more, 3,116. That was sporting goods, musical types. 10-year they were at 61 million. They were down a negative 3.4 for October, 5,918. So they're not doing that well. Sporting goods, instruments, and even bookstores are all thrown into one. General merchandising stores, department stores, 103 million. And they were down a negative 4.9. And 10,042,000 was October. And last October, if my column's not off here, they were at 11 million, basically speaking. Then there's miscellaneous types. They were doing a little better, 2.9 there. October, 12,129. Non-retail stores, elect shopping, etc., 12.7 million. Food and drinking places, they were up 4.3 at 65,323, and a year ago they were at 68 million, not 87. So you kind of see how the story was there. The drinking places basically pulled them out of the doldrums, so to speak. Little different situation there. And see where we are now. Yeah, this is a shorter forecast, no doubt about that. Well, let me dive into some of the market numbers here. This is from CNBC in more of a quote-unquote quiet week. The Russell 2000, it up at, let's see, 1,596.45. The change was 7.66. As for the Russell. And the NASDAQ 100, it was up at, actually we'll give this, at 57.69. And the Russell, that would be 7.66. Utilities were also up at 2.94. Trans 5. And the S was 100.96. Let me get back up here. These are some of the index. And the New York Exchange was up 222.93. The NASDAQ at 61.81. The S&P 500 at 23.8. Bond was up 0.21. VAX was down at negative 1. In other words, it was at 12.05. The change there was a negative 7.66 there. Gold was also down at $1,468.70. That was a change of 0.32%. Petroleum was resting at 57.93. Gold was. The euro was at 1.05 of a dollar there, and some of the commodities, natural gas was also up 0.0. Silver was down. It was rested $16 and 0.935. Copper was actually up, not 0.1. Wheat was down a negative $5. Soybeans were up 1.25, and corn was down. Haven't given this in a long time. A negative of $5 there. Won't give the price of it because again, that's to the average viewer. And here are the T-bills. That was down. The 3-month was down a negative 0.005 at 1.569, and the 1 year is down also at 0.547, and the 2 year was actually up, not 0.21 at 614. The 5-year was also up, so we're not having inversion here, at 1.653, and then actually would have been, the change would have been 0.28. And the 10-year was also up, change being there 2.1, and the 30-year was up. Actually, the 30-year was at 2.308. The 10-year at 1.836. So there is some changes there with you don't, in other words, you don't have your 2-year and your 10-year sitting at the same place. So that is a change there. Won't look at the currencies. And let's see what else we can find here from CNBC. We'll go over to the BBC now. Brent crude, I think we talked about, was at $63.30. That is a change of $1.02. West Texas crude at $57.72. It was up 95 cents. T-Bone Pickens' actual ancestors looking at that relatively ever. Gold was down $2.05, resting at, this is on the Forex, resting at $1,465.06. And let's grab some of the other markets that for one reason or the other we left out here. We'll start with the FTSE, 10.18. It's the FTSE 100. In Amsterdam, they were at 7. In Paris, they were 38.19. In the DAC, in Frankfurt, was at 61.52. The Eurostrasse was at 22.8. Everyone had a good day. And in Madrid, they were at 88.10. And we gave the Dow, but anyway, it's at 2,800, 004.89 for those aficionados there. And we got the NASDAQ, we got that one also in Bombay. In Bombay, it was 0.17. The Hang Seng in Hong Kong, 0.1% change there. Or actually, let's just give. In Bombay, they were at 70.21. In Hong Kong, 2.97. And in Nikkei, 161.77. So that is a roundup of our markets on a week. But there really wasn't a lot of financial news out there. People, of course, in North America are looking towards the holiday week, which will be next week, the pre-Thanksgiving sales, the Thanksgiving sales, Black Friday, you name it. We're only about a week from that. That'll all start next week. Some places it has already started in earnest. The big question is what will consumers do, what they will not do, how they will react, how the overall economy leaps on. But we do have these basic questions in many cities. San Francisco on sustainable housing policy there, housing growth. It doesn't benefit the majority of the citizens. I was noticing some place in the Midwest they were adding some of these $1.2 billion condos, something a little different from that area. So what we're seeing is more and more concentration of wealth in various cities across the U.S., and then we have the rest of the people. And as the median price of housing going up, or rents go up, one can hire a place several $1,000 that's not subsidized. There are many cities moving into subsidized type of housing arrangements. But is it too little, too late? What you have to have is a development plan for sustained development. You simply just can't add housing units willy-nilly, because in San Francisco they have thousands of homeless people. They can't add enough housing to take care of those people. So they have to come up with sustainable development, which they're 20 years behind in, and they just simply cannot continue on with these headquarters as being there in the rest of Silicon Valley. Now we have the electrical brownouts or what have you because of environmental factors. In other words, the fires are there. So they now have to cut the power off. How will this affect the tech industry? So far, these cutoffs have, in many places, only lasted, say, 24 hours. Some more than 24 hours. You can't run your devices. You can't run your mobile phones. They're sporadic. So you're starting to see the environment having dollar costs, real-time effects on the economy. And as the Fed is looking at this to see what happens, they have now in Australia, 40 kilometers outside of Sydney, and they're just in the spring time there, and is in the summer. Water resources, there's a problem there with those. Some communities literally do not have any water because of winds. They can't get their helicopters in. These are all things that are starting to contribute to the economy, and this is why one financial commentator, this is for the U.S., talked about the Fed and Congress. The Fed, their mission is monetary policy, dealing with inflation and dealing with employment. But the problem with employment is that it is from different areas of the country, different things are happening. And of course, 2020 being an election year, we'll hear more and more about Medicare for all, the public option, etc. There are other schemes to lower the price of prescription drugs. But in summary, this is a very unbalanced economy. A lot of psychology of the market put out there without really the type of stable economy we had. After the Depression, the economy started to stabilize. Although it was not producing as many jobs at that time, but it was producing jobs. Now, then when the new administration took over, they took on a massive tax cut, which you normally don't do massive tax cuts unless there is a downturn, not when you're coming out of a downturn. So in other words, I should say the American nation, are starting to see the results of some of those policies. Your unemployment number, redundancies, you want to call it that, did in fact go down. But the real number now is 7.5. Before that it was up around 10% or more. But you still have these problems because what is happening, you're creating a lot of lower paying jobs. The bulk of your jobs are lower paying. So a worker has to have 2 or 3 jobs. School teachers in many of these states went out on strike. They were driving for Uber or for Lyft. And that was unheard of when I was in school. Teachers made enough. Their pensions were adequate to supplement them when they retired at 65. And at universities, it's basically the same thing. But now it is a totally different situation because of the price of homes. If a consumer is in the area lucky enough to buy a home, the mortgage payments are higher but not forbidding. But then you go to the automobile economy. Now you have 7 and 8 years to pay for the automobile. It used to be that the automobile itself would basically be obsolete in 5 years. So you're getting a situation where consumers are tied down with expensive, prolonged automotive payments, student loans to get, quote-unquote, a job. Many times that ends up with 3 or 4 different jobs. So that is the type of economy we have on November the 17th, 2019. A very mixed bag. We'll be looking very, very carefully at the retail sales when it is over. That'll be in December. This is Q4. And Q4 sometime is a precursor to Q1 of 2020. And there are many, many things that can happen. Where does China go? Actually, we looked at the PCIs, China's economy was, parts of it were stabilizing. All of these economies over a period of time, even when they are in very bad shape, do stabilize at the growth rate where they are. They get moderate growth, if I quote Dr. Williamson there at the market economics. But this moderation there is probably the key in industrialized society, or moderate growth as they call it. You're not going to get spectacular growth, but you also have these sectors that are experiencing a growth. I noticed in Louisiana they have added jobs there, but they are still stuck at $7 and was it 25 cents. That's the federal minimum wage. They have to improve that particular situation. So again, we are seeing the takeaway here, more and more of what is macroeconomics is not only the central banks, but the political, whether it be a parliament or Congress, having to intervene in this economy. So in other words, you don't have laissez-faire, you don't have free market. When you got tariffs, you threw the free market out the door and the laissez-faire. So now regulations, position mean more than not. For those in business, have a productive next week. For the consumer, keep your eyes obviously on the prize. See you next